Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Our special series, unveiling, interpreting, analysing, unpacking, seems to be a term everyone likes these days, unwrapping the Fast 50 Report 2024 basis is where to put your money now for the best capital growth in 2024. We've brought together leading minds of people inside of Australian and around Australian property to curate this report. This is the list of lists. This is bringing together every single part of this property ecosystem together with their own interpretation, looking for those commonalities of where the best operators in property are advising their clients or recommending the best places to buy. We've done the heavy lifting for you. We've worked it out. We started off with 178 recommendations. We've narrowed that down to 50. And this is the Fast 50 2024. It's the fourth podcast as part of our series to pull it apart and unpack it. We've been speaking quite a lot about different things, timing the market being one of them. I really enjoyed that conversation, which you would have listened to a couple of days ago. We also spoke about investing across different budgets, which yesterday. So this is the fourth of our special 6-part series. If you haven't listened to the other stuff, go and do it before this, because they got to get the sequence right, because we're going to be referring back to some of those conversations. But let's get stuck into it. Joining me back in the studio, the partner for the Fast 50 Report 2024, Paul Glossop from Pure Property Investment. Paul, it's been fun.
It has been, mate. It's been really enjoyable. Good organic chat and some pretty live, organic and dynamic data dumps that we've been having along the way too. And today's going to be no different. I'm aware that we're going to be talking a little bit about regional v metro.
Regional v, which seems to be what everyone likes to talk about, regional versus metro. But no doubt your team's already fielding phone calls from people who want more information around this. You're happy to chat to people about the report if you need to.
That's why we put this together, mate, is to talk to more people about both potentially things that they're considering doing, things they have done, and what their plans are for the future. Because one thing we probably haven't talked too much about is execution on this. We talked about timing, we talked about delays, and essentially the cost of doing nothing for a year versus doing something today. The reality is you've got 50 suburbs in this guide. If you haven't already downloaded it, smartpropertyinvestment.com.au, you can get it. But once you get this list of 50 and you potentially say, that's the suburb that I really am focusing on or want to focus on, the asset in which that market sits in and the actual crux of the property you're going to invest in, to be completely honest with you, you can get potentially above and beyond average growth for the next 12 months if you buy the correct asset in that same market. That's when you double down. So you double down on the growth, you buy that asset ideally off market, below market value, potentially with some upside to the land, potentially with some better cash flow opportunities, and then you get that additional growth because of the propensity based on the data, based on all the other attributes that we've discussed. That's what our job is at purepropertyinvestment.com.au, because we're giving away essentially the secret sauce. But what you can't give away is how you buy these assets.
Yeah, that's
you just can't give it away.
And a lot of people just go, I'm not telling you where I'm buying. You go,
No,
well, okay, mate, that's fine. And they're probably tuning into this.
They are.
But I like it, right? I get it. It's quite good fun. I go, that's fine, but you still got to go out there and find the asset.
And we've always said that. I mean, I've talked about every single market we've always been buying in, or we're going to buy in, or we've stopped buying in. And markets that I'm personally buying in, markets that my buyers agents are buying in their own portfolios. We talk about it all the time. And I always am happy to give it away, because we always know what goes into it. Is that we could have a competition of 50 people on the same property, but ultimately what goes into buying that asset and what we say no to, it's the old adage of, it's the salmon that John West regrets.
The Chinook salmon.
How I ever know that? It's what they reject that makes John West the best.
It's what they reject.
But that's our job, is that we reject property day in, day out, time in, time out, and we constantly are going to do it. And that's our job, is to eventually say, that's the property.
That's right. So the Chinook system. So it's good. It's good for other people, but not so good for you
not
and your
good for us,
clients.
because we have to provide value. We charge a fee, and we need to make sure that fee is justified, because we can get above and beyond opportunities that people just can't access. And that comes down to about 95, 96% of assets that we buy just aren't advertised.
Yeah, because you're hustling in the background, finding these assets. They're not on the market, these places.
That is it. And again, I could go into any one of those markets, and if someone gave me a call right now and said, do you have any property off market in Armidale, in Mandurah, in Brassel, in Clayfield,
Mm.
there's a number of markets in there from low price points to high price points. If you want off market and you want something that's below market value, that's a distressed sale. Our job is to find those assets.
Like everyone else, that's the problem, right? It's
Yeah.
such a. But to the point, you know, we've got some very good buyers agent who have participated and contributed in this to give us their insights and stuff. Like the huge advantage you have by using a buyer's agent, Pure Property Investment, for example, over trying to do it yourself. If you're trying to do it yourself, you've either got to make it a full-time job to make friends with all these agents.
Yep.
So they're thinking about you when they find and they get a read on a listing.
Yep.
Or if you're just doing it via the internet on realestate.com.au, like you're shackled. You know, you're shackled. You just, it's uncompetitive. It's incompetitive.
It completely is, and you've got to do your own values of what your net worth is or what your hourly rate is. And if you're in a PAYG or you own a business or a combination of those two, you would probably know what you earn. You break it down on a per hour basis. I can pretty much go out on a limb and say I could guarantee you that I can beat your hourly rate in what we can get. That
But people go, but
comparable.
it makes it so much more expensive.
And
you know.
price is what you pay, value is what you get, Phil.
Yeah.
And we all know that. And I mean, it goes down. We've spoken about this. It was probably about 50 podcasts ago. You can go to a builder for a renovation. You can say, I can do it cheap, quick, and well done.
Yeah.
You can only have two.
Yeah.
And this comes down to buying property. Is you can get it done probably one of those, two of those three. You can never get three of those three. And ultimately, that is when it comes down
Under
to
market value really fast.
And I want to get it. I want to get the perfect property. Essentially. These are the scenarios that we always talk about.
So how often, and it must happen. So I know someone that we both know who I think ended up using you.
Yep.
Who I remember he's this good friend of mine.
Yep.
Going, I don't want to pay Glossop and his guys that money. I'm going to do it myself. And then he'd be calling me out going, God, I can't find anything. You know, what they tell me it sells for so much more and it's impossible. It's impossible. Then they call you guys up and say, I'm done with this. Like, so they've already got all that sunk cost of trying to do them themselves. And then they go, I'll just actually get someone to do this for me.
And it's a bit of a
it must happen all the time.
It happens more often than
but
not.
people just think it's unfair, you know, these agents that aren't telling me, you know, it's not truthful, you know, it's like, but the reason why is that you're operating in the open market. You're competing stuff that's out there, right? You need to be going to find the good stuff, right? And in terms of finding the good stuff, I've made the point before on this special series. Half of these suburbs I've never heard before. Yeah. You know, so how do you find the good stuff? You find the stuff that no one else knows about yet.
Yeah.
And that's the basis of this past 50 report.
They'll all be known about, unfortunately, very shortly.
Yeah, sorry. Maybe you're going to get the keys to the city for some areas of Western Australia. The man who's done more for price growth in Western Australia.
I don't think it'll have that gross effect. But I know we say that a bit in jest. But
we do. But regional Australia, to be fair, is pretty well represented out of the fast 50, and obviously there's 178 shortlisted, recommended properties, I'll call them, which we turned into the 50. So there'll be a lot more regional ones in there.
Yep.
But 12 of the 50 are in regional Australia.
Yeah, and that
so what you'd expect.
It's about the, if you look at the population movements of Australia, and you deem what's the top 15 cities or regions in Australia versus technically regional, it's about that represents about 20-ish percent, which is about right as far as where they represented in that market.
So of the regional properties, highest price point, 700 grand, medium price, lowest, 340. Metro markets, highest price point, 1.8. Lowest price point for regional, for metros, 305 for Armidale, which we spoke about the last podcast. So again, pretty good spread.
Yep,
pretty good spread. I do note though, if I average the medians, 463,000, and then if I average the medians, 5 for metro, 569. So
which again is about right.
Cheaper to invest in regional Australia.
Yeah, which always has been.
It's more affordable locations in regional Australia for investors. But
generally speaking, there's a reason behind it.
Right?
Yeah, exactly. And I think this is not a new conversation or a new topic within smart property investment either. Is that regional versus metro, which is best, etc., etc. And historically, there's been a bit of an argument to it to say, well, you're usually going to get better yield versus growth in regional, and conversely to that, in metro, you're going to get better growth versus yield, and then also you can overlay that with commercial versus resi, and then there's a whole different cover of conversations that come with that. But I think ultimately what this suggests is that you will get a spread of people who just for whatever reason want to stick to major metro, and conversely to that, you'll get people who are happy with regional versus metro, and then you'll also get people within metro who will say, look, I don't want to touch WA as an example, or I don't want to touch Tassie, or I don't want to touch SA. I want to be on the East Coast. And I've heard that plenty of times with clients that come to me and say, I'm only interested in investing on the East Coast. And part of our job is to try to educate, but to a degree as well is that, we're not the ones signing the contract of sale when it comes to sourcing a property. So if someone's not comfortable with it, our job's not to try and convince someone to do something they're not comfortable with, because they need to be able to be comfortable with the decision they made, not the decision someone made on their behalf. So I think the beauty of this list in general is that you've got about 20% that are within regional. Some people say, I just don't care where the property is. As long as it fits my brief, I'm comfortable investing in it. Yeah, and that's what this represents.
And there's some real proponents for regional property investing.
Absolutely.
Part of this, I think, is Simon Presley, who we know. He's a very good operator, head of research over at Propertyology. He's big on regional Australia.
And pretty much predominantly has always been, from my understanding. I mean, not that I know exactly what he invests in. I know he's quite cagey about it, which I'm quite surprised he's probably given away a couple of his properties.
Well, the thing is that there is no suburb in here where we disclose who's made the recommendation. So as is what I've curated, there's a whole bunch of people's recommendations. And that's helped us shape the list. And we've spoken about the methodology beforehand, but he's a huge proponent for investing in the right regional markets. But he also sort of invests in metropolitan markets. Well, I haven't spoken to Simon for some time, but just going on the basis of our chats beforehand. Guys like Steve Waters, you're on the board. People with him again. He's not scared to invest in regional locations.
He's agnostic, and nor are we, for that matter. I mean, I would say that our average is probably the average of what you're talking about there. About 80% of what we buy is typically major metro. And that is just due to the fact that majority of the places that we see that have got opportunity. But I would list off markets that I've bought in regionally over the years. Could range as far as Cairns to Townsville to Bundaberg to Toowoomba, out towards Mount Gambier. We've bought in Launceston, in Devonport, in Burnie, in the Hunter Valley, down towards the south coast of New South Wales, the north coast, far north coast of New South Wales, Geelong, out towards the surf coast, over towards the Mornington Peninsula. The list goes on. They're markets that right off the top of my head, I know that we've bought in over the last 10 years.
You were investing in a regional location, Salisbury 5108 in South Australia. You're not buying there now, but I know, and I'll disclose this, that you're investing in Rockingham, WA regional market 6168. So, and again, if you're speaking to a buyer's agent, they go, we don't look at regional. Okay, well, you've got to work out what's right for you, but you might be missing out. But the point being, it might change over the years. This is where to put your money now for the best capital growth in 2024. So, and
an interesting one there I was going to ask Phil is that, and this might answer some of those people who are doubting Thomas's about the actual growth in these, is if we look at, going back to, I know we've done this as a bit of a theme over the last few podcasts, but if we look at quarterly growth as well as 12-month growth, and if there's a way for us to maybe even look at dissecting the regional that we've deemed regional versus the metro that we've deemed metro, it'd be a good understanding for people, because they won't get it in the report per se, because the report is a static report. This is more of a dynamic back end.
You can go through and you can pick it out.
You get the abacus out and start to calculate.
So but you know what's really funny, you get really bright sort of actuarial type people, right? Try and work it all out. It's too smart for me. But regional markets, median quarterly growth, Paul, tops out 6.8%, bottom 0.7%. So that's Salisbury, WA 5108, 118 properties sold, median quarterly growth of 6.8%, average annual growth 6.2%, and 12-month growth 23.7%. So that sounds as though it's still there, kicking along. And you're not there now. You've not been anymore. In there. You've gone. So if you were there a year ago, that means those people you've bought have got a 23.7% uplift. Again, it comes down to time.
If it was a year ago, it might have been a little bit longer than that.
Yeah. But on that basis, though, it's only grown at 6.2% of the average annual growth. So
it's majority of that growth tells you has happened in the last couple of years.
But it's still kicking along at 6.8, right? 6.8 quarterly growth. You compound that out over another 4 quarters, you're looking at another
20%
20
plus.
20% growth, right? So this is the clues you can see in the numbers. But the other side of that, Churchill 3842, which I think is part of the Latrobe Valley, I think. Yep. It's a bit of a regional hub. Median quarterly growth 0.7, 12-month growth 20.7, and average annual growth of 8.1%. So
might tell you a story there that
maybe it's sort of at the end of its accelerated growth, not but maybe it's all good. This is it, right? It's only grown 0.7 for that quarter. What does that tell you? Well, maybe there was less properties for sale.
Potentially was, but it might also start to tell you that the inertia is starting to wane a little bit.
To wane a bit. Then you've got Mickleham, 3064. Average price $700,000. I'm not really familiar with this market, regional market. 257 sold, median quarterly growth 2.8, average annual growth 16%, 12-month growth 10%.
There you go.
So it's grown less in the last 12 months than what its average annual is. However,
that average annual is exponential.
It's exponential, and it's growing at 2.8%. So you would assume. It should stay in that same trajectory. It should do about another 10%, 12-month growth, which is below its average annual growth. But 16 is high.
That's very high.
It's an anomaly. It's strange. It's something must have. So I just get something's happened there at a point in time. Might have been 2, 3, 4 years ago. But you look at it's $700,000 median price point. So not knowing where that is, I'm going to Google it right now because I reckon it's got to probably be acreage that's got popular, is what I'm going to say.
Yeah, it's probably not a bad call, and I think there's a few markets in Sydney as well as in Victoria, in particular, that have gone through that very, very big population expansion.
See, this is a suburb. Here we go. It's a suburb of Melbourne, Victoria, Australia. It's 30 k's north of the district. So we've got that classified as regional, which once upon a time it probably was. And if you look at it on Google, all it is farmland, which I reckon has just been rezoned.
Yeah.
And it's right next to
basic extension of Dandenong and out towards Narre Warren, etc.
Yeah. So the reason why that's done well is that's acreage selling for the purpose of development.
Yeah. And you know that it basically borders the highway, and there's been a lot of land on the other side of the highway there that probably has gone through that's absolute fringe Melbourne. It's absolute fringe Melbourne. And see, like, and to the point, I don't know a lot of these locations, but you look at the data and you just go, yeah, okay, there's stories I can tell without even looking at it. Yeah.
And this is just going to be sliced off, and this is going to be greenfield development. Yeah. That's the fringe of Melbourne.
Yeah.
Which, in probably 50 years' time won't be the fringe of Melbourne.
No, correct.
So on that basis, would you be, there's a winery there?
It's just near the hills. Yeah, just near the hills there. But I think to the point, then, if you go say, hey, look, $700,000 for a northwestern fringe market of Melbourne, then you overlay it, and you got to overlay to say, well, again, going back to what we talked about a few podcasts ago, is that you're chucking in 10% deposit plus closing costs. You're probably talking 110, 120 grand minimum to get into that market that you need liquidity wise, let alone borrowing capacity. And then you overlay that with the yield. And look, I'm going to take a stab in the dark. You're on the other side of the laptop to me here, Phil, but I reckon you're probably talking a 3 to 4% gross yield on that particular suburb at that particular price point. And then you've got to start to think, can I afford to hold that if my interest rate's 5.5 to 6%?
3.2%, $430.
There you go.
But looking at a Google, and I know probably it's dated, but already you see these little squiggles and plans of it's just greenfield site.
Yeah, it's already been sliced up and diced up, and there's probably a fair bit of off the plan and houses that have potentially
and
made
you can
up for those
see,
sales.
and as part of it, you can see they've built in an area for like a shopping centre and all that sort of stuff. So on that basis, like maybe you've missed Mickleham, maybe you should be thinking about what's next up that area, Mandalay.
But even the equivalent of in other markets, and every major city, and this is probably goes back to, we talk about regional versus metro, every major city over time, when you're talking 1.5 million, 2 million population, over time, urban sprawl happens. And it simply just happens because you run out of either land and the inability for councils to be comfortable rezoning existing land to go vertical instead of going horizontal. And this is what happens, that these areas, they exist in every single major city that we have in this country, and they will continue to happen. And I know we spoke about it maybe a week or two ago, a separate podcast about a 1968 excerpt on ABC about a young couple coming out of an auction house in Canberra that was on the fringe of Canberra, and they were just essentially selling blocks of land. And they were talking $2,000 at the time, and they were saying, well, why do you think it's so expensive? Well, they were saying, I just don't think there's enough supply, and there's too many people out here, there's too many people moving to the area. Guess what? It's going to continue to happen.
Yeah, and then you look at another regional market, and you look for stories, right? And you can tell a lot through data. There's one here, median price $550, which is on the high side, second highest regional market. And I know there's people going to be tuning in, just going, guys, you're idiots. Mickleham isn't regional; it's metropolitan.
Correct.
It's fringe, right? It's right at the fringe.
It's like talking about Leppington and Sydney. It's not regional.
Yeah,
it was.
It was. Is it? Maybe, I don't know. No, it's not. But 550 average yield 4.8, not bad. 510, right, is a median rent. 12-month growth 16.9%. Average annual 4.1. Median quarterly growth 2.3, and it's been 199 sales there last year. You look at that and go, that's
healthy.
That's worth looking at, right? That's worth looking at. And I'll tell you where it is. It's Yeppoon.
There you go.
And Yeppoon, and you jump on Google and you go, okay, that makes a lot of sense, right? It's got Shoalwater up there. Oh, that's interesting. That's where all the military stuff is. Striking distance to Rockhampton.
Yep.
Right, Rockhampton, inland city, I guess you call it. Have you been to Rockhampton?
I have.
What's it like up there? Is it
as expected?
Humid?
Humid. Can't really swim because of the irrikanji and the crocs. And if you're into fishing, or essentially you've got some association with caravanning or part of the, the army and the army side of things up there, there's a bit going on. Also in the mining space is where a lot of the employment comes into that market. It's similar to where Townsville, it's similar to where Mackay, it's similar to where Bundaberg, it's similar up even further towards Cairns. Those markets are driven by relatively similar dynamics, and yes, you have to be a certain type of person to enjoy that kind of climate and lifestyle, in my opinion.
Mate, I'm looking at Google right now, and the coastline, they're beautiful beaches, mate. There's no one within QE of any of these places, right? No. Like you just go. It's like beaches there, hundreds of kilometres, and not even a house near it, right? So Yeppoon is on the coast,
correct?
Striking distance to Rocky. So I imagine if you worked in Rockingham, you probably weekend at Yeppoon. Maybe I don't know if you commuted each day, but it's a big-ish regional centre. And looks like it's performing well for the purpose of property investment. But this is down to this dichotomy again of, do I do regional or do I do metro? And, we're talking about 12 regional markets. There's 38 as part of the Fast 50 report, which are metropolitan markets with price points from $305,000 to $1.8 million. So when do you actually shift? Should you go regional if you don't have to go regional? Does that make sense?
And that's probably, this is a very subjective part of, I guess, where the opinions of the experts who have contributed to this guide are, because obviously you've got people who have obviously recommended Yeppoon, and I'm not one of them, nor would I be one of a number of the other markets in the regional markets, particularly in this guide here. But they've got their own rhyme and reason behind why they'd recommend it. I guess if I was asked that question, Phil, and I'm constantly asked that question because a lot of the time clients come and set up some time to talk with me, they may have already spoken to a buyer's agent or two in the past, or maybe already using someone else and want a second opinion. And they might say, look, I've had some advice to say we should be buying in Yeppoon or the equivalent of, and we've already deduced the fact that they might have $450,000 to spend. They need to get a certain amount of yield. They've got X amount of property in their portfolio. The reality is I would rarely, and I personally would suggest rarely probably means that 1 in 100. Could I justify buying in Yeppoon at, sorry, what was the average price there? I assume it's in the 4s or 5s. There you go, 550. If someone said to me I had 550 to spend,
good yield, 4.8.
4.8. It depends.
Okay,
yeah.
Horses for courses.
Exactly.
Right?
But if someone said that to me and they say, look, I've got a 10-year, 15-year horizon, I would struggle even out of this Fast 50 guide. I would struggle to put that anywhere near the top of what I would recommend to a particular client. And therein lies a subjective.
And there is the point where a lot of people would say, Doesn't matter whether it's regional or metropolitan. You go where your money's going to do the heavy lifting, and we'll see what happens in a year's time. Maybe Yeppoon will outperform maybe some of the areas that you're investing in, which we've spoken about in WA. But just to give you some geographic concept of this, if the areas that you're investing in WA, call Armidale 6112. Let's call that London. Yeppoon is Moscow. That's how far these places are away. Like, seriously.
Oh, they are. They absolutely are.
Like, you flippantly talk about these markets and stuff. But to get from like the UK to Moscow, France, Belgium, Germany, Poland, et cetera, et cetera, et cetera. Like, you're crossing countries, right? We just go, Yeppoon, it's up near Rockingham and Armidale, it's sort of 30 Ks or so from the first two. Mate, they're completely different markets.
And it's an amazing thing about Australia, and it always will be, is that you just can't draw a parallel with the Australian property market. We've gone through 12 months of absolute fluctuation, and we always hear the media aggregate data to say the market's done this. Well, the market averaging out 500,000 properties across the country that have sold have done this. The reality is that Yeppoon has done this. Mandurah has done this. Armidale has done this. Clayfield has done this. And as we've just demonstrated, anyone who hasn't downloaded the guide already needs to download the guide, because they will see that these numbers are extremely stark in the fact that you've gone through what some have termed to be quite possibly one of the worst downturns Australia's ever seen as a national average. But yet here we are talking about 50 individual markets, which have all grown in value, some of which have grown exponentially in value. Some are still growing exponentially in value. And some of the yields that they're producing are very, very strong at the same time. So this is the reality, is that you need to dig deeper and you need to ask a lot more about the why, and then you need to execute really well as and when you get to the point of actually deciding where you want to invest.
Absolutely. And also as you go through the report, you'll see this, right? I'm going to call it clustering, right? Let's talk about Queensland, for example. So we're talking about Yeppoon. Yeppoon's sort of northernish Queensland, but then there's other places here, and you look at Queensland as a state has dominated a lot of the 18 out of 50, right?
Yep.
It's a good whacker in Queensland. Let's go for that. 18 are in Queensland, 15 in WA, 2 in Victoria, 1 in Tasmania, 10 in South Australia, and 4 in New South Wales. So Queensland, then WA, then South Australia, then New South Wales, then Victoria.
And how many metro versus regional in WA? I'd assume it'd be the same average. If you're probably talking 20% regional, 80%.
So there's what did I say? 15 in WA, 13 of them are metropolitan.
That's in Queensland.
Sorry, in WA. So Mandurah and Rockingham.
Yep. And that could be argued that they're still part of metro, but that's a small portion.
Sort of fringe stuff. And then in Queensland, 3 are regional.
There you go.
Yeppoon, Harristown, and Maryborough. I'm pretty sure they're all regional.
Yep.
And then there's 15 which are metro. But then you look again in the clustering of that, right? And you're a lot better than this than I am. But a lot of them are clustered in very similar areas. So if I get this right, 1 Mile, Raceview, Redbank Plains, they're all Ipswich.
Yep.
Correct?
Which, if you're a Brisbane local or Southeast Queensland local, you might say that Ipswich isn't Brisbane.
Yeah.
But, is it close enough to the fringe? We talked about, the Victorian example or the Melbourne example, that the fringe, what's Leppington? It's fringe. It's,
Collingwood Park's in there as well. So a lot of them are, clustered really close together.
Yeah.
You could have just said Ipswich.
Yep.
So you could have just counted Ipswich as one rather than these suburbs of Ipswich. So give me an analogue of Ipswich in Sydney?
You'd probably
Scrambletown.
You'd probably give it either the Penrith, broader Penrith. May get too comfortable with Scrambletown, mate. It's my old stomping ground. It was back in the day.
Yeah.
But Campbelltown the like, Penrith and the like. If you're sort of the way inclined of let's say way inclined of Melbourne, it's probably not as far as Geelong.
No.
It's probably somewhere between Laverton and Geelong. Or down a bit past Frankston, the equivalent, or maybe about Frankston. The distances are about the same.
It's like a little micro city.
They are.
It's a satellite city.
They are. That classic 45 to 50 minutes. I was actually only in Ipswich and also in Moreton Bay and a number of those markets only last week, driving through, looking at some sites and going through some numbers there. But you realise it's actually really well connected.
Once.
Yeah.
I went to Ipswich. Amberley.
I was going to say down at Amberley. Yeah, which is one of our largest RAF bases. And again, one of anchor tenants. And you talk about larger anchors to employment of areas. That's not going anywhere.
I spent a night in Ipswich.
Yep.
Just as a hotel near the station. I went and walked the main street. I really liked it.
It's Queensland.
Yeah,
it's
great.
You get Queensland.
Drank about 1,000 4Xs in a
mid-strength. It's good.
In a really old pub. So good. I really enjoyed my time.
There is a bit of heritage in that area, actually.
That little high street bit.
There is actually some beautiful heritage property, and Ipswich is a very old town.
Yeah, it feels regional though.
It does. They've kept it that way to a degree as well. And there's actually a fair bit of heritage overlay to a lot of property in that area in general, which is actually quite good long term for those markets.
Yeah, so you're going to get this. So metro or regional, horses for courses.
Yeah,
is the summary on that.
I agree.
But you would say that the weighting of regional versus metro is probably pretty reflective of what you would expect it would be.
Absolutely. Yeah. And if I even weighed up my own portfolio, Phil, and the last X amount of time, long period of time, I personally bought a fair few dozen properties in my own portfolio, totaling tens of millions of dollars, and I'm still doing it today. It's reflective of what I'm looking for to fit a piece of the bigger puzzle.
Yeah,
and I always look at it sort of a bit more. If I look at it that way, different people's puzzles are different sizes. Some people like the smaller puzzles that only have 2 or 3 bits and they're pretty straightforward and simple. Others puzzles, they are more complex and they need to find different ways to fit them because they just don't have the same pieces in major metro markets, whether it's growth, whether it's affordability, whether it's future development upside, whether it's land banking, whether it's cash flow, whether it's commercial versus resi. These are the things you find in different markets to fit different pieces to that bigger jigsaw puzzle that we're trying to fit.
And this comes back to property strategy and where organisations like you help, but you just don't find property where you help them plan.
Absolutely, that's the first step. It has to be the first step.
Yeah, and that's what they say. You can't have a goal without a plan.
Yep.
And you can't plan without a goal, right?
Just rattling these off, eh?
Yeah, you like that.
Well done.
Yeah,
did you coin that one?
I think I just did.
Why not?
Maybe I can be a social media influencer.
Maybe that's a send off every time.
Is it? I can't even remember.
I know. I'm trying to remember what you said. Is it what I reckon? Try to
something about planning.
Something
about planning.
You're planning to fail here.
No. But there is a thing. It embraces the OODA loop,
right? Which
is plan, brief, execute, debrief, plan, brief, execute.
You always love to bring it back to a defense analogy.
It is good. Yeah, well, that's a version of the OODA loop.
Yeah.
Makes sense though.
It does.
Plan.
It does.
Tell people do it. Anyway, that's Paul Glossop, CEO of Pure Property Investment. You can have a chat with him if you want. If you want to have a yarn of you and your team, best way
1300 985428 or purepropertyinvestment.com, or simply shoot me an email, inquiry@purepropertyinvestment.com. Any of those ways.
And you have a chat shuffling decks of regional portfolios and all that sort of stuff.
Everything.
Yeah. Okay. All right. Yeah, you got that there. Remember, download the report if you haven't downloaded it. I imagine most of you have downloaded it now. This is the fourth podcast of our 6-part special series. So if you haven't yet done it, smartpropertyinvestment.com, there you go and find it there. Download the report. Look forward to seeing you again tomorrow as we get stuck in our 5th installment of this special series. Until then, hope you have a good afternoon/evening. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.